With investing analysis on today's healthcare headlines, this is your Market Checkup. I'm Allison Southwick. Thanks for watching. I am joined by David Williamson and Max Macaluso, healthcare analyst at the Motley Fool. Today we're going to talk about downgrades in big pharma and give you an update on Obamacare. But first, we're going to look at today's big movers, starting with Ariad. They took a huge hit today for the second time this week after the FDA announcement that it has concerns over the safety of the leukemia drug Iclusig. Max, what can you tell me about these concerns?
Well, Allison, we talked about this on Wednesday when the stock dropped around 65%, and that was when the company came forward with the trial results that around 11.8% of patients taking the drug for 2 years had problems with blood clots, and it was a very serious problem. It looks like today the FDA came out and said that they're investigating this, taking it a little bit more seriously. So shares are down another 18%, and it makes sense because Iclusig is really the company's main asset.
Right. So, David, then this sounds like it'd be really bad news for Ariad.
It is really bad news, and the last drop over the couple of weeks. I mean, the shares are down 75% over the last month, as Max said, essentially another 20% today. Iclusig is a drug that they were looking to expand into 9 total indications. So before all this problems, the stock had a value, close to $4 billion. It was well over $3 billion. Now it's down around $800 million. So, the company right now has a run rate to sell less than $100 million worth of Iclusig. So I think you're seeing that value coming more in line with the current market cap, because the truth is safety issues are likely not going to be confined to just patients with leukemia. This could be broader across all the different indications they're trying to expand the drug to. And so it really could limit it as a last line drug, because you really don't want a 1 in 10 chance, which is what it comes down to, of serious blood clots. I mean, this is a potentially life-threatening issue. So if there are other options, even if maybe they're not as efficacious, doctors may push that way. It may be hard to move up in the treatment ladder where there's more money for the company. They still have a non-small cell lung cancer drug, so you don't want to write off this company is not having any value. Clearly, they have an approved drug. It has value to some extent. It's efficacious, right? It works. It's just potentially it has some safety issues, and that's the bottom line. And I think this sell-off really pretty accurately reflects that. I should warn investors, though, if this investigation turns out poorly, shares could keep collapsing. So there's no reason to think that this is definitely the floor for the company.
Yeah. Our other big mover today, Amarin, is down roughly 18% after the FDA panel says that their fish oil pill may not be as effective as previously thought. So, Max, how much less effective are we talking here?
Well, it's hard to say, Allison, and Amarin is kind of a curious case today. Shares were bouncing around down 6%, at one point down 9%. It really dropped to 18% just about half an hour ago. So to be honest, the briefing documents in anticipation of the advisory committee meeting on the 16th came out today. It's 100 pages long, and I'll be honest with you, I haven't read the whole thing yet, but I did jump to the conclusion, and it brought up some things that I didn't really think about with Amarin and its drug Visipa. One is that there are concerns about the mineral oil that was used in the placebo, and it might block the absorption of statins in the trial. That's something I really didn't think about. And also the last line of the document says beneficial treatment effects of Visipa relative to placebo may be overestimated. So it doesn't sound great, but we're going to have to wait until the 16th to really see what the FDA decides. The advisory committee will really give us a clue as to how the FDA will decide. We have to wait and see. This is a true binary event.
Right, so we obviously don't know a lot yet. 100 pages. I'm sure you're all going to be reading it over the weekend.
That's what the weekend's for.
Yeah, exactly. Fun stuff. So do you think this one little fish oil pill merits such a drop?
I'm concerned, just as Max is. I think when you look at it, it's a little surprising that the trial design became a bit of an issue, because they received an SPA, which is really an FDA sign-off saying, we agree with your trial design, we agree with your endpoints. Amarin aced these endpoints, so I think a lot of people thought they'd be able to expand into an indication with it, which has 36 million potential patients. It's much larger. This was really part of the growth story for the company. If they can't get there, I think it's not going to be a dead money stock like they're stuck in clinical development, but sales will probably not take off to a dramatic degree. I mean, estimates for this drug are around blockbuster status, potentially as high as that's where their competitor by GlaxoSmithKline, Lovaza, sits at right about $1 billion. This drug is shown to be a little more efficacious than Glaxo, so people thought that would be a reasonable estimate for it. The other concerns are that were raised during the briefing document were the cardiovascular benefit. And we've seen a lot of studies come out that show these fish oil drugs don't really produce better cardiovascular outcomes. Now, Amarin's running a large-scale cardiovascular outcome trial. That won't play out until 2016, so it'll be interesting to see what happens there. It is a pure binary event. It's funny, after this came out, shares tanked, but a lot of the investment banks jumped in. Goldman Sachs actually defended the stock. They raised their price target upon seeing it, and they said there was a 60% likelihood of approval. I'm going to probably flip that, go the other way. I'm going to say it's a little less than 50%. I do think there's a better likelihood of the advisory committee pushing it through, and then the FDA putting on the brakes. I think that's probably, if I was going to give my guess, that's probably what I would say.
All right, let's move on from the movers today, and we've got some news from Vivus. They have announced a partner today, but it wasn't the one we were all expecting. So Max, tell me about this new partnership.
That's right, Allison. So Vivus is mostly known for its obesity drug Qsymia. I'm sure a lot of people reading the press release this morning got excited, thinking perhaps that the partner was for that drug, but in fact they have another drug called Stendra that's FDA approved for the treatment of erectile dysfunction. Now, Vivus already has a partner, Menarini. It's an Italian company. That's to commercialize the drug in Europe and also in Australia and New Zealand. The deal today is with Auxilium, and it's a $300 million deal potentially if all the regulatory events and milestones come to fruition. And actually, it looks like a pretty good deal. It fits with Auxilium's portfolio very well. Vivus definitely needed a partner to commercialize this product. But keep in mind, it's a competitive space. We have Pfizer and Viagra, and another competitor, Eli Lilly and Cialis here. So,
and potential generic competition coming soon as well.
Yeah, in a few years. And also, I still think that the key for Vivus is its obesity drug.
Right, so then let's talk about the obesity drug, if that's the one we really care about. David, what are you watching when it comes to their obesity drugs?
Well, I'm watching the sales numbers, Allison, and the prescriptions, and it's going to be interesting because, I like a lot of investors, I saw the headline, Vivus gets a partner, and I was like, oh, wow, the new management went and actually found one. The old management was talking about finding one. First Manhattan was a big shareholder. They're a hedge fund. They got the old management thrown out, brought in their own people. But not a lot has changed, but it doesn't necessarily have to. Sales have been actually ramping up pretty well ever since they got their drug into retail pharmacies. It was restricted to mail order at first, but now it's a competitive space. Arena has Belviq. Orexogen is a company that has an obesity drug, Contrave, still in development. It's running a large phase 3 trial. It's actually going for European approval. It could be the first of the three to actually get European approval. So they wouldn't actually be competing there. It would be the only one in Europe. But it'll be interesting to see what happens. I really am waiting, though, for the quarterly results of both Vivus and Arena. I'm really excited to see what they say as far as sales, as far as rebates, just hear what they're seeing on the conference call, giving forecasts. So it'll be really interesting to see, and investors should stay tuned for that.
All right. So in other news, the healthcare analysts over at Jefferies have been very busy today.
Yes,
they downgraded AstraZeneca, Merck, and Eli Lilly. AstraZeneca in particular got picked on. The analyst called it his least preferred European stock.
Yeah.
Out of all of them.
Out of all, I really hope it was just healthcare, because really, you don't like AstraZeneca, as much as Peugeot, the troubled French automaker, or Nokia. I mean, I feel bad for AstraZeneca, but taking a look at these downgrades, we at The Fool don't put a whole lot of weight into Wall Street analyst downgrades, but these are some of the more troubled big pharmas, and they've seen really a lot of similar issues, which is problems with drugs they currently have on the market, and a lot of clinical trial failures in late-stage development. Merck has Januvia, their best-selling drug, under pressure. There's some risk of pancreatitis potentially with their whole class of drugs. They had Tridaptive suspended. Eli Lilly had solanezumab, an Alzheimer's drug, fail both of its phase 3 trials. It had a BACE inhibitor, another Alzheimer's drug, fail in mid-stage development. It had ramucirumab just the other day, fail in breast cancer. So a lot of late-stage failures for Eli Lilly. AstraZeneca, Onglyza's been a bit of a disappointment. They had a trial disappointment, and they got rid of a rheumatoid arthritis drug, fostamatinib. Forxiga got rejected here. So there's just been a lot of problems with all of these stocks. So, I don't begrudge Jefferies for downgrading them.
All right, Max, what did you think about the downgrades? Did the analysts get it right here?
Well, I agree with David. I really don't follow these downgrades and upgrades that closely. I just do my own analysis and try to form my own opinion. I'm not that enthusiastic about Eli Lilly right now. Their earnings are set to contract in the next couple of years, really because of patent expirations. You look at Cymbalta, it's its top-selling drug right now. Patent is set to expire in December. Evista is another one, 2014, the patent will expire there. So I haven't been that impressed with their pipeline, but in this space, things can change quickly. If they make one smart acquisition, we could be telling a different story next week. Don't think that's going to happen, but just in case it
but
does.
But it could cover your bets. Yeah.
AstraZeneca is in the middle of a turnaround. I'm sitting on the sidelines, not quite sure what to make of it yet. I think they have a smart CEO, smart management in place, but again, it'll take another while before I kind of grasp what the strategy is going forward. Merck actually has performed well this year, despite, like David said, having some problems in its pipeline, some regulatory setbacks. But they're shaking up their R&D structure right now. They have a new head of that division, and I think they're doing the right thing by cutting costs. And they do have some interesting assets in their pipeline. So of the three, I'm more excited about Merck than AstraZeneca or Lilly.
Yeah, I would probably echo Max's thoughts. If I were to rank them, I would probably say Merck is my favorite, Eli Lilly in the middle, and AstraZeneca may not be my least favorite European stock, but it's my least favorite of the three. Their CEO, who's relatively new, he's been on the job about a year, basically admitted the company is going to be in rough shape for the next 3 years, 5 years, till they can really turn it around.
But that being said, David, they have been making some acquisitions lately.
They have been, yeah.
They've been boosting their pipeline, and they're moving their R&D center in Europe to Cambridge. So I'm kind of partial to Cambridge.
But on the other side of that, their diabetes partnership with Bristol Myers has been pretty disappointing as far as gaining traction for Bydureon, Byetta, and Onglyza. So it does need an overhaul. I think they can get it turned around. I don't think any of these companies are going out of business. I don't think you have to worry about that. Eli Lilly has gone heavy into treating cancer and diabetes. I think their diabetes portfolio has a lot of potential. So, in 5 years, maybe Eli Lilly is actually the best of these three. But for the time being, if I had to pick one to put my money in, I would pick Merck. They have lambrolizumab, which is a PD-1 drug. These are the immuno-oncology drugs that everyone's excited about. Theirs is the second furthest along, so it is right behind Bristol's. And they have a BACE inhibitor that's pretty far along. When Eli Lilly's failed, they said, this isn't a class problem. It was specifically our drug. So now Merck is in the driver's seat as far as that drug class. So there are some catalysts for Merck. I do like what their R&D head is doing to shake things up there, trim costs. A lot of these companies also still have animal health and nutrition businesses and things they could spin off if they want to raise capital as well. So there are a lot of ways they could shake things up and get things turned around. And I think they all recognize the problems now at hand. I think there were blinders on for a while in the pharma industry, and they're all reorganizing in their own different way.
All right, well, that's going to cover it for some of the headlines. But first, before we go anywhere, we got to have our Obamacare update. Yeah. According to the Wall Street Journal, one potential bargaining chip with Obamacare could be on the table, and that's the medical device tax. So, Max, what can you tell us about these negotiations?
Right, so there may be some negotiations in the future to repeal this tax. Of course, the article stated that they would have to replace that $30 billion, which is expected to roll in over the next decade somehow. So, to be honest, some of the bigger players have been affected by this. You look at Stryker, you look at Medtronic. Of course, you don't want to have this excise tax in place. At the same time, they're large enough to kind of weather it. And also, the Affordable Care Act is going to get more people onto insurance, and that should be a tailwind for a lot of these companies. But as an investor, I think it's always good to be aware of what's happening on Capitol Hill. I wouldn't necessarily change my investment thesis on speculating that this tax would be repealed. I think instead investors should focus on the underlying businesses and really just base their investments on that.
Yeah, consider it a nice little cherry on the top if it does get reduced or repealed.
Right, but again, very speculative. I wouldn't factor that into any modeling.
Yeah, still go for the business that you like.
Yep.
All right. And then all this week we've been talking about glitches with the healthcare exchanges. David, you've got an update on what's going on as far as remedying the glitches.
Yeah, it turns out Washington is copying Washington, and by that I mean Washington, D.C. is going after the Washington State model for their healthcare exchange. Now, the Washington State one worked really well, and what they do is that they allow you to sort of browse the plans before having to enter any personal information. information. Now, this was originally intended to be a feature of the healthcare.gov sites, but they pulled some features back just trying to get the thing up and running. Of course, it wasn't really up and running that well. We saw a lot of glitches. That was the big news, both from users on the front end and insurers on the back end not getting correct information. They're having to go through by hand now and correct that. So I'm sure there's someone in a room at an insurance company very unhappy with these healthcare exchanges. But the problem is that we saw with the exchanges surrounded some Oracle software, and I wanted to make sure I got the order of operations right, but the exchanges are run by CGI Group, and they have to talk to Quality Software Services, which is a United Health subsidiary that does work with Medicare, and then there's also Experian, which collects a lot of the information, and they all sort of talk at this Oracle piece of software. Now, this is a common piece of software that Oracle sells to a lot of systems, and Oracle is saying, listen, it's working fine, but clearly, there's definitely some configuration issues that are happening here. It will all get straightened out, but it's sort of interesting that I think they may have made a tactical mistake by, instead of not having that ability to browse to begin with. What happened is to be able to see it, you made people go through the registration process, which is what makes all these systems talk, and that led to all the crashes where a lot of people just wanted to window shop, right, and see what it was all about. So we actually probably would have had less glitches if they had prioritized that feature. So it'll be interesting to see. And there was a study done that said over the 2 million people who tried to register for an Obama through the healthcare.gov on an Obamacare exchange, only 125,000 made it through. So that's what, about 5%. That's just a terrible conversion. So we'll see what happens. It will get fixed. I'm sure these companies will get it straightened out. But that's basically where we stand right now.
All right. Well, thanks, you guys. That's going to cover it for today. If you're looking for more analysis on the Affordable Care Act, Obamacare, and all of the healthcare news from the day, we've got you covered at Fool.com. For David Williamson and Max Macaluso, I'm Allison Southwick. Thanks for watching.